Ralph Migliozzi here with RC Advantage Mortgage Lender. We're going to be talking about applying for a mortgage from a consumer point of view. So when I consult people, I do it as if I was speaking to my sister. So that's what we're going to do here. And we're going to talk about not only the loan process, but also the biggest surprises you can run into that neither the loan agent nor real estate agents necessarily talk to you about. There's a lot of assumptions that are made. So some of the terms I'm going to use, I won't necessarily define. I'll define as many as possible. But for the ones that I don't define, you can go to rc-advantage.com and look up in the glossary all of the loan terms that are used in the industry are there. So I would use our site as your Bible when you're applying for a loan in a loan transaction. So first off, that's going to happen is in order for you to get started in this process, what should you do first? Should you get a real estate agent or should you get a loan agent? The industry right now is doing it the wrong way, the exact opposite way. What they're telling you is to find a real estate agent first, and that is not the way to do it. A real estate agent can't show you a property until you're qualified. So our industry, in order for you to even look at property, just so before you get started, so you won't be disappointed, a real estate agent, if you contact them, would say, have you been pre-approved for a loan transaction? Before you can even look at a piece of property. And also, under the new rules that just came in effect, you have to enter into a buyer agent's agreement now with the buying agent. So if all that sounds too daunting for you, you can always give us a call and we can walk you through that at 530-330-3073, and we will give you a step-by-step of how to proceed, which we're still going to do here right now. So rather than calling a real estate agent, you're going to want to call a loan agent. In general, don't do stuff by email, folks. Email is too confusing of a process for this. This is one of those times you're going to need a face-to-face. A phone conversation or a video conversation is crucial in understanding this process. Texting and emailing will not do it for you. So be prepared to talk to somebody live on the phone if you're going to get this and understand it. So the first thing you're going to want to do is an idea of what you qualify for. In my opinion, what you should do is take an application over the phone. Now, if you choose to do that online, that's fine, but you're not going to be able to talk to anybody about what it means after you get pre-approved. Generally, what happens is someone will call you back from a call center that's not a qualified loan agent. Let me say that again. Someone will call you back from a loan center who's not a qualified loan agent. So you really want to apply with the loan agent who's going to be working with your real estate agent in order to submit this loan to a lender. So the first thing you're going to do is take a loan application by phone. Now, if you want to, you can take a loan application on their site. I do not recommend you take your own loan application. That's like doing surgery on yourself if you have cancer. You're not going to want to do surgery on yourself. You generally go to a surgeon who's a pro. And a loan application should be taken by a competent loan agent, in my opinion, to make sure you don't put the wrong things on there. So what should you have with you on your person when you're going to take a loan application? Well, you should know your social security number, have a general idea of what your debts are and your payments. You should pretty much know what the address of your job is and the phone number, how many years you've worked there. If you haven't been on your current job for 2 years, you're going to want to also have your former job information, where you worked, what the phone number was, and what the address is. All that information should be available at the time you decide to take your loan application. You should also have your checking and savings account information for where your down payment is coming from. Your down payment is going to be the amount of money you're going to put down on the purchase price. So for instance, if you're buying a house for $500,000 and the down payment is 3%, that would be $15,000 down. So pretty much on our application, we're going to be asking you that information. So you're going to want to have at least your bank information, and you're going to want at least to have the last 4 digits of your account number. And if you know that much so far, that's going to be enough for a successful loan application. The next step is once the loan agent qualifies you and gets back to you, he's going to give you a purchase price and a down payment. Then the next step is to go ahead and do your credit report. Now, many people balk at doing credit report, and they want to go to Credit Karma or one of these free companies and try and run a credit report. This is the first surprise you're going to have. And you're going to run into several surprises that we're going to help you with overcome. The first surprise is, believe it or not, folks, those free credit reports do not come anywhere close to what a mortgage report is. We're getting what's called a factual data report. It's totally different than what consumer FICO scores are, and unfortunately, you do have to pay for it. Now, you may not want to run that report until you're ready to make an offer on a property. It's not necessary. But generally, you're going to have to run that report. There are a few companies that will advance the credit report for you and have you pay for it at the close of escrow, but most will charge you in advance for a credit report in order for you to get pre-qualified or pre-approved. This credit report is not your standard credit report. It gives you all 3 bureau scores. When a lender gives you pre-approval, in our industry, it's your middle score that we use to qualify qualified. Not your highest score and not your lowest score. It's your middle score. So after you get the credit report done, then generally you're ready. Then ask you for, write this down, 2 recent pay stubs, W-2s for the last 2 years if you're employed, most recent bank statements, all pages for the last 2 months, and your driver's license. And that's pretty much it. If you're self-employed, they'll ask you for 2 years tax return. If you haven't filed your 2003 tax returns, they'll ask you for 2021 and 22 and a copy of your extension for 23. 23's, I think, just you can still do an extension through October. So once you've done that, you supply all that information to the lender. Your lender will refer you to a really good real estate agent. I highly recommend your lender refer your agent. Do not pick your own agent. Picking your own agent is like picking a divorce attorney by going through the phone book. You would never do that. You get a referral for a professional. And again, you wouldn't look at an ad for $500 off brain surgery if you needed brain surgery, right? You would ask a professional in your industry who's the best brain surgeon in town. That's the same way it works for mortgages. So you don't want to die on the table, folks. So get a referral from your loan agent, who the best real estate agent is to use, and you should be working with them as a team. You usually do not want your loan agent and real estate agent not to know each other. Bad idea. Generally, you want them to be a team and working together, in my opinion. Okay, so you've gotten past the first 2 parts. Now the lender is going to write a pre-approval letter for you that says that he's seen your income, your credit, and your documentation, and what he's qualified you for. And with that letter, you now can go and look at property. Now, the other thing that's important to understand is this is not spoken about at all by real estate agents or loan agents until your offer has been accepted. And that is, what are your closing costs and down payment going to be? Now, I was just talking to a borrower, and the borrower said, we're going to put $45,000 down. When I told the borrower how much the closing costs were, she said, oh yeah, well, my realtor told me that we're splitting closing costs with the seller. Folks, that's a common mistake, and this is another one of the big surprises you're going to run into, is the closing costs, all the closing costs are not split automatically by a buyer and seller. When a listing agent says you're splitting closing costs, it's a good sales ploy, but all it means is that you're splitting title and escrow, which is a very small amount of your closing costs. So when the contract says closing costs, it's just talking about title and escrow being split. That's not including your whatever loan fees you're going to have. You're going to have to talk to a loan agent about whether you want to pay loan fees or whether you want those fees subsidized. And that should be done prior to you making the offer. You don't want to be surprised that all of a sudden you have, believe it or not, a $400,000 purchase price in California. If you're in a high fire area, your closing costs could be as much as $16,000, $14,000 to $16,000 on a $400,000 sales price. If you're not in a high fire area, take that down to about $13,000. Now, you can make many of those costs go away. You might pay about $150 more a month, but you can get rid of all the closing costs by having the rate subsidize those fees. So that's all important information you need to know. So what do I mean by that? It's called a rebate. And so when you pay points in a transaction, and points is a percentage of the loan amount. So if your loan amount was $400,000 and you were paying points, that would mean a origination fees, points to buy down your rate. That's an additional $6,000, 1.5 points. Generally, you're going to want to do a no points loan, which means no origination fees. But you can also go the other direction, folks. You can actually have the lender give you up to 2.5 points back in the form of a rebate. And on a $400,000 loan, that is $9,000 off your closing costs. Again, your payment's higher, but you get this gift from the lender. So all that should be discussed in advance before you make an offer. And to me, this is the second biggest surprise in our industry. The fees are not discussed in advance of your offer. Subsidizing your fees are not discussed in advance of your offer. And you actually could have the seller pay your closing costs if you're worried about the fees, which also generally is not discussed in advance of your offer. So these things need to be discussed in advance of your offer. And what was the second biggest surprise? Discussing how your closing costs are going to be paid and how much they are. So now that the process is finished and you've discussed whether closing costs are going to be paid by the seller or by you, generally when you're asking the seller to pay closing costs, you're usually raising the sales price by the amount of those closing costs. So if the purchase price was $400,000 and you're asking the seller to pay $10,000 in what we call recurring and non-recurring closing costs, which I'll explain in a minute, that means that if the seller doesn't accept your offer, you can raise the sales price by amount of the closing costs. So instead of $400,000, you would offer $410,000 and have the seller pay $10,000 in recurring and non-recurring costs. Is that going to raise your payment? Certainly it is. Not a lot though, compared to having to come out of pocket $10,000. All right, so what does it mean to pay recurring and non-recurring closing costs? First of all, the biggest portion of your expenses in Northern California is going to be non-recurring closing costs, believe it or not. And what are recurring closing costs? What are recurring closing costs? Recurring closing costs is your fire insurance. You have to have fire coverage on your house. Interest, recurring interest that you're paying on your loan. Tax impounds. If you're going to impound your taxes and insurance, if you're putting less than 5% down, you're going to generally have impounds where you're paying your taxes and insurance in advance or setting it up in your closing costs. You generally have to pay 6 months of your taxes in advance. And if you're buying a house for $400,000 in California, your fire coverage is probably going to be somewhere between $3,500 and $4,000 in high fire areas. In low fire, places that are not in high fire coverage areas, your premium is going to be a lot cheaper than that. So your non-recurring costs are costs that don't occur again. They occur only when you're buying the property. Recurring costs occur every year. So non-recurring costs would be any points that you paid if you decide to pay them, any origination fees, including underwriting. The lender usually has underwriting fees. Any junk fees that the lender has, which would be between $150 and $200. Any escrow fees, which is going to include half of escrow in general, you're going to split with the seller, and half of the owner's title policy. Now, in some counties, you don't split half of the title policy. It's the owner pays it all, which is great. The transfer tax is usually paid by the seller, which is about that is a little less than, it's about 0.11% of the purchase price. So if the purchase price is $400,000, the transfer tax is like $444. The seller pays for that. All of the rest of the closing costs you're going to pay unless the seller, you negotiate with the seller, including your appraisal fee, your underwriting charges. As I said, half of escrow, half of title. There's what's called a lender's policy that you have to pay for in general. That's about $700 or so. And notary fees you'll have to pay for. Appraisal, it depends on what size property you're buying. So those are the important things to understand. So once your offer is accepted, you're going to sign, a contract's going to come to you that's going to say purchase contract, and you're going to sign all this stuff and initial it all, and the real estate agent will explain it all to you. Once that happens, then the seller's agent will then negotiate with the seller, and they will usually accept your offer or their counter offer. That counter offer says, you know what, we're not going to pay your closing costs for you, so unless you want to raise the sales price, you'll have to decide whether you want to do that and accept their counter offer. You'll go back and forth on the counter offers, and then once your offer is accepted, the next thing that's a surprise that you're not always told about, this is the third surprise, you're going to have to pay inspections out of pocket. So whatever inspections you're asking for, you have to kind of check for those, and no one tells you that in advance of the transaction. So if you're going to do a whole house inspection to inspect to see if the house is in good shape, that could run anywhere between $400 and $650. Cha-ching! Big bucket ding-dongs, right? So that's important to understand that you're going to pay in advance. Guess what? Appraisal is to be paid in advance too. So before you know it, you're at $1,200 and something out of pocket. And any other inspections that you decide you want to do, including pest inspection, could be as much as $250. That's also out of pocket. So talk about that with your agent, because you could be up $1,500, $2,000 out of pocket before you even get started. So that's the third biggest surprise that is not discussed between your loan agent and your real estate agent going forward. Then what happens is after all the inspections are done, generally, here's another problem. Surprise number 4. Surprise number 4 has to do with, generally, I wouldn't do my inspections until the appraisal's done. Now, a lot of people are going to be mad at me for saying that, but that protects your money, folks. What if you do all the whole house inspection and the appraisal and all these inspections at once, and then the appraisal doesn't come in at value, or there's some kind of problem on the property? If you know there's an issue with the property that's going to be called out in the appraisal, why would you do the other inspections and then have the appraisal fail? Now you're out the inspection fee, the termite fee, and the property doesn't even appraise. If you know there's going to be problems with this property, I would be very careful about doing all 3 inspections at once, because you're going to lose your money. Do one inspection. In my opinion, it would be the appraisal first, because you would want to make sure the appraisal passes before you do anything else. If the appraisal passes, then you're fine with doing the whole house inspection. Why in that order? The lender sees the appraisal. The lender does not see the whole house inspection, and the lender does not see the termite report. So if any issues pop up on that and you don't want to fix them, you don't have to. But if issues pop up on the appraisal, guess what? You're going to have to fix them, because the lender is going to require you to. So this big surprise number 4, folks, really important and never discussed in a real estate transaction. You're prepared now to go ahead and make your offer and understand that you're going to go ahead and do things in this order. Next, you have in California a 17-day contingency generally, which means you can quit for any reason and get your deposit back. I would never be worried about writing a check for deposit. You can't lose it unless you decide decide to waive all your contingencies. Contingency means that you are electing not to go forward for any number of reasons. You have a built-in loan contingency and a built-in appraisal contingency. That means that you have to remove those to lose your deposit. And you have to remove all your inspection contingencies to lose your deposit. So I'll be called on the 17th day and they'll ask you, can we remove loan and appraisal contingency and inspection contingencies? And I'm going to ask you, is that what you want to do? And I'll tell you if they can be removed or not. Once those are removed, then documents are drawn and you either go to escrow or you can sign them in the comfort of your own home. Surprise number 5. Okay, generally you're not told that the notary fee, which is between $175 to $200, can be waived if you sign the documents at title. Did you know that? So if you sign the documents in the comfort of your own home, it's going to be cha-ching, $175 to $200 just to do that. If you go to escrow, you can sign them and not have that notary fee waived. Now, if you're outside the area, generally you're not going to be able to go to escrow. You're going to have to sign them remotely. And if you sign the documents remotely, you're going to pay $175 to $200 to do that. So then what happens, folks, is your source of funds is going to have to be wired to escrow. You can do a cashier's check or a wire. A wire is an easier way to go. You're not going to know the exact amount of that money that you have to put in until you get what's called the CD. So just before you're ready to close, you're going to get a CD, which is basically the commitment that what the amount is you're going to be bringing to escrow. Once you see that amount, you can start getting your money ready. You won't know the exact amount to the penny until the escrow officer gets your loan documents. So once the loan documents are drawn and go to escrow, it's at that point that the loan agent should be directing you to call the escrow officer in the transaction who is handling your loan documents. Then you can wire your money. You get wiring instructions from escrow, and you go to your bank and you give them the wiring instructions and they send the wired amount to escrow. You sign your docs at the same time you do that, or you can get to wire the money after you sign your documents. Once the money is wired, then the lender funds your loan the next day generally and records it. And folks, that's the loan process from beginning to end with all the surprises that you can experience. This is a crucial video for understanding the home buying process. Thanks for listening. If you like this, please subscribe to the bottom so that we can get more idea of what kind of videos you're interested in. And you can go to our website and get our home buyer's guide that walks you through a lot of the stuff. So don't forget to do that. The Home Buyer's Guide it's called the Essential Home Buyer's Guide, and you can download it for free at rcadvantage.com. Thanks for listening. Have a great journey.